Don't look away from the screen, because what you are about to hear is not just a financial lesson, but a true story about how money is being redefined right before our eyes. Think about gold. It is shimmering, it is heavy, a safe haven asset trusted by civilizations for 4,000 years. It sits deep in vaults, a store of value when the world descends into chaos. But what if I told you that gold has a new challenger, something that cannot be confiscated, cannot be melted down, and does not physically exist, something born from cryptography and protected by mathematics? I am talking about Bitcoin. And here is the shocking truth. The giants who once laughed at it, the world's largest asset managers like BlackRock and Fidelity, are now lining up to buy it. Not millions, but trillions of dollars. They no longer view Bitcoin as a crazy experiment. They see it as digital gold. They have changed their minds, and that change is about to change everything for you. Understanding the shift, where gold failed. To understand how Wall Street changed, we must understand where gold failed in the 21st century. Gold worked well for 4,000 years because of its natural scarcity. But after 1971, when President Nixon severed the last link between the dollar and gold, the collapse of the Bretton Woods system, the world entered the era of fiat currency. What is fiat currency based on? Trust and the government's promise. And those promises have been broken. For over a decade, central banks have engaged in quantitative easing, simply put, printing money at a breakneck pace to bail out the system. Imagine this: you have a pie. Gold is a pre-cut slice of that pie. Fiat money is a pie that the central bank can make as large as it wants. Physical gold still holds value, but it has become cumbersome, difficult to transport, and most importantly, it has become an easy target for government confiscation during a crisis, e.g. Executive Order 6102 in the U.S. in 1933. Wall Street knew this, but they had no better solution until the birth of absolute scarcity. In 2009, amidst the global financial crisis, a mysterious phantom named Satoshi Nakamoto planted a seed of an idea. They created Bitcoin. Not a company or a government, but a system of rules. The most important rule is not how fast transactions are, but its scarcity. There will only ever be 21 million Bitcoins. That is not a goal. That is a mathematical law written in code. You cannot print more of it. You cannot mine more of it once that limit is reached. Satoshi created something that physical gold cannot have: absolute and transparent scarcity. Gold, approximately 20%, remains unmined. The exact amount is unknown. Bitcoin, the figure 21 million, is a public fact. Furthermore, the rate at which new Bitcoin is issued is cut in half every 4 years, the halving event. This creates an internal deflationary pressure. Wall Street initially scoffed. They called it a money laundering tool, a bubble, magic internet money. But their eyes could not leave the 21 million figure. The BlackRock conversion. The shift started with whispers and then a thunderclap. BlackRock, the world's largest asset manager with over $10 trillion USD under management. Their CEO, Larry Fink, was once a fierce skeptic. So what made a man who manages more assets than the GDP of most nations change his mind 180 degrees? It was pragmatism. Fink and his rivals realized the global monetary system is leaking value. Their clients, pension funds, insurance organizations, needed an inflation hedge not controlled by the central bank. And they realized that in the digital age, physical gold is too cumbersome and difficult to transport. Bitcoin, conversely, can move billions of dollars across borders in minutes at a low cost. Larry Fink announced, "Bitcoin is digital gold. It is international." When BlackRock speaks, Wall Street listens. This was their confession. They were wrong about Bitcoin's ability to store value. The Spot Bitcoin ETF, the master key. Suppose you're a pension fund manager. You want to buy Bitcoin because you believe in its scarcity, but you can't. Why? Due to the lack of a safe market structure. Pension funds cannot buy Bitcoin on regular exchanges. They need secure custody. Who will hold the private keys? What if it gets hacked? Legal compliance. The product must be approved by the SEC, U.S. Securities and Exchange Commission, and comply with anti-money laundering regulations. Ease of trading. It must be easily bought and sold through the traditional brokerage systems they have used for decades. Raw Bitcoin did not meet these requirements. It was too wild for the traditional financial world. This is where the Spot Bitcoin ETF steps in, like a master key. How does the ETF work? BlackRock or Fidelity, they are the issuer. They buy the actual Bitcoin on the market and custody it with a trusted institution like Coinbase Custody in a highly insured digital vault. SEC, this agency controls and regulates the fund's activity. Investors buy shares of the ETF, e.g. BlackRock's IBIT, on the traditional stock exchange through their current brokerage account. They have separated the technical risk from the price exposure. Institutional investors get exposure to the Bitcoin price without having to worry about private keys, cold wallets, or risky exchange regulations. Suddenly, from an asset only for crypto experts, Bitcoin has become a standard asset that can be in anyone's 401k portfolio. The trillion-dollar math. Let's talk about money. This is what Wall Street really cares about. The total assets managed by large financial institutions worldwide is a staggering figure, estimated to be in the hundreds of trillions of dollars. Let's do a simple and shocking calculation. If a giant pension fund has $1,000 trillion USD in assets and they only allocate 1% to Bitcoin, that is $10 billion in new inflow. Now multiply that 1% by the total assets of institutions globally. This is not inflow from individual investors buying $100 or $1,000. This is a structural shift of trillions of dollars, moving slowly but relentlessly into an asset with a fixed supply. Bitcoin's scarcity, 21 million coins, makes every new institutional dollar have a multiplying effect many times stronger than other assets with flexible supply. The game has changed from "will Bitcoin exist" to "what percentage do we allocate to it?" The digital upgrade. Physical gold will not disappear. It is a valuable asset, but Bitcoin has proven itself to be an upgrade for the digital age. Think about wealthy or even ordinary people in countries with collapsing currencies or strict capital controls, e.g. Venezuela or Turkey. They don't need a bank. They don't need paperwork. They just need an internet connection and 12 key words. Bitcoin becomes the ultimate type of economic insurance. When your government prints money to devalue your assets, Bitcoin is a borderless escape. This is an advantage that physical gold, bound by law and customs control, cannot match. Bitcoin's free movement and censorship resistance are the core value Wall Street is seeking to diversify geopolitical risk for their clients. Low correlation. Smart risk management. In the financial world, diversification is divine. Investors don't want everything to crash at the same time. One of Bitcoin's most appealing characteristics for institutions is its low correlation. In many periods, when the stock market, S&P 500, and bonds went down, Bitcoin performed independently. It's an asset whose price behavior is not entirely bound by traditional macroeconomic factors. It is bound by its network adoption and its own halving cycle. For a fund manager, adding a low correlation asset to a portfolio reduces overall risk and increases risk-adjusted returns. This is not about taking a reckless bet, it is about mathematics and smart risk management. The grand vision, tokenization. If you think BlackRock is only concerned with selling the Bitcoin ETF, you have missed the much bigger picture. The acceptance of Bitcoin is not the endpoint, it is the beginning of a larger revolution, tokenization. Imagine, one day you don't buy a share of Apple.
You buy a token representing a fraction of an Apple share on the blockchain. You do not buy a house. You buy a token representing 1% ownership of that house. Why? Efficiency. Instant transactions, instant clearing, no need for expensive and slow intermediary banks. BlackRock and Fidelity are building the financial infrastructure to operate in this tokenized asset world. The Bitcoin ETF is their training ground. They are learning how to custody, how to resolve legal issues, and how to interact with blockchain technology. Digital gold is the first asset Wall Street accepted for tokenization, but it will not be the last. The theory is, once they succeed in bringing Bitcoin, an entirely new and decentralized asset, into the traditional system, they can tokenize any other asset. Fund managers are positioning themselves to be the gateway between the hundreds of trillions of dollars of traditional assets and the future of finance on the blockchain. This is a long-term strategic vision. Whoever controls the easiest tradable products will control the capital flow of the future. And they know that the foundation for trust in this space is Bitcoin.
The final verdict: trusting math. Finally, this story is about trust. Historically, we trusted gold because it was so hard to find. Then we trusted fiat currency because we trusted the government and the central bank. Today, we are witnessing a shift. Trust is being placed in public mathematics and transparent cryptography of Bitcoin. Wall Street is not saving Bitcoin. Bitcoin is saving Wall Street's portfolios from the erosion of fiat currency value. And when the world's wealthiest start moving their assets into digital gold, that is an unmistakable signal of where value will be stored in the decades to come. You do not need to be an institutional investor. You do not need to be a tech expert. But you need to understand this: you are living in an era where two financial systems collide. The old system is based on debt and promises. The new system is based on fixed scarcity and inviolable mathematics. BlackRock and Fidelity have chosen a side. They have accepted Bitcoin as the ultimate store of value of the 21st century. The question for you is, will you accept it? Or will you stand outside while this great asset transfer unfolds silently? This is no longer a story about potential. This is a story about reality.